Hello, everyone. My name is John O'Donnell, and thank you for all joining us today. You know, there's an ancient Chinese proverb that says, "May you live in interesting times." Well, we've certainly all been blessed to live in interesting times, haven't we? I'm the Chief Knowledge Officer of Online Trading Academy. That means I do a lot of our primary research that ultimately goes into our content. If any of you would like to reach me after the event, my email address, john@tradingacademy.com. The title of my talk today is Why Gold, Why Now? And I don't necessarily mean why gold long, or I just mean why gold, either long or short, why now? And we're going to take up this conversation about gold. You know, John Kennedy, I remember when John Kennedy was assassinated. I was a sophomore in high school. And John Kennedy said in a Yale commencement address in 1962, back when we were on a currency standard that was convertible into gold, he said, "The greatest enemy of truth is very often not the lie, deliberate, contrived, and dishonest, but the myth, persistent, persuasive, and unrealistic. There is a myth that surrounds gold, and gold as money." And we're going to take a look at this today. And little did Mr. Kennedy know that in 1962, here we would be all these years later, decades later, quoting him as it relates to something like gold. One of the positions in gold where I like to trade my gold is on the New York Stock Exchange, Life Exchange. They have a new contract, a mini gold and silver contract. And I'd like to bring it to your attention. If you haven't heard, the New York Stock Exchange bought the old Life Exchange and also bought the Chicago Board of Trade's gold and silver mini contracts when the Department of Justice forced them to delever. So if you want information on that contract, you can email metals@nyx.com. They'll send you a nice PDF form on how that contract works. It's metals@nyx.com. So let's get into this. For those of you that don't know about Online Trading Academy, we started out as a broker-dealer way back in 1997. This was our trading floor. This was just one side of our trading floor. We had 180 traders that would trade over $500 million a day of equities trades. We weren't a school in that era. We evolved and became a school, and today we teach trading of equities, options, futures, and currencies. And I've done a lot of work in gold. I used to own a gold and silver reclamation business. So I go back to the early 1970s with gold, and I've had an incredible relationship with it over the years, including from 1980 through 2000 when we had a 20-year bear market in gold. So I'd like to do a survey of my audience before we get started. First of all, how many of you believe that world economic uncertainty will continue the balance of 2010 and 11? Give me a little bit of feedback, would you please? Type some text. Do you believe that world economic uncertainty is going to continue? Yes or no? Well, we have a pretty well-informed audience here. I agree with you all. We believe here at Online Trading Academy that the world, not just the United States, or not just your country, but the world is in the midst of the worst economic slump since what I call the Great Credit Purge of the 1930s. And in fact, we don't call recessions and depressions those words. We call them what they are. They are credit purge eras. We can debate what comes first, the credit purge, where weak credit instruments are literally purged out of the system by default, or whether the recession and depression creates the conditions that purge the credit. It's a chicken or egg debate, but at the end of the day, it is what it is, and it's going to have a big impact on the price volatility of gold and silver and other financial instruments going forward. And I want to share with you what our perception of what that looks like today. At Online Trading Academy, we break capital and recommend that our students and graduates of our school break their capital into two buckets. We call it an A bucket and a B bucket. An A bucket is a small bolus of capital that you would use to speculate with. You might trade foreign currencies, you might trade equities, options, futures, whatever. Your B bucket is the bucket on the screen now. This is that large corpus of your wealth that is denominated in multiple assets. This is that bulk of your estate that you're not speculating with, that you're probably shepherding and gardening from a very conservative perspective, because at a later date in your golden years, you want to call upon it to support you. Probably in this B bucket, you would have stocks and bonds, and some of you have precious metals, real estate, cash or cash equivalent. You might have a subcontext of this account, might be a trading account, or you might have other assets. But at the end of the day, ladies and gentlemen, we believe that the world is evolving to what PIMCO calls the new normal. And it will be an era that will have a big impact on both your A and B bucket, because it's going to be an era led by global demand destruction and global credit purge. You know, the credit crisis that caught so much media attention in the summer and fourth quarter of 2008, it is still with us. We still have remnants of it. It's now moved out of the subprime real estate mortgage category into the Alt-A mortgages. It's now moved into the commercial mortgages. It's now moved into automobile receivables, credit card receivables, and now it's even moved up in the sovereign debt category. And we'll take a look at sovereign debt here in a moment. There are many, many countries whose sovereign debt instruments are very stressed, under a lot of pressure, and it's creating a tremendous amount of uncertainty. And part of the problem is many of these countries have issued their debt in currencies that they can't print. And we'll talk about that in a moment. But we believe here at Online Trading Academy that we are at the end of an era. And what era are we at the end of? Well, the era of cheap liberal credit. Let me ask you a question. I don't know what country you're located in. I know FX Street is notorious for having an audience all over the world. But in America, by the way, why don't you let me know? Type in the text chat. What city or country are you located in? We've got about 42 people that are in this session right now. Where are you located? Give me an idea of what country or city you're located in right now. Very good. Okay. Excellent. Our people in the old normal, people used to go out and borrow money against their home. That was known as mortgage equity withdrawal in America. And then they go buy a new car. Is that happening in your neighborhood today? Are people borrowing money against their home and buying a new automobile? Well, I can assure you it's not happening in America. Very, very sparingly is that phenomenon happening today. And it used to be a regular occurrence. And the primary reason is because there's this great debate raging in the world today about, are we going to have inflation or are we going to have deflation going forward? Now, I'd like my audience to vote on this. And I need to know where my audience stands on this debate. And it is a debate. Both sides of the debate make very persuasive arguments, as is the world going forward over the next few years. Are we going to have inflation or are we going to have deflation? So here's what I'd like you to do. I'd like you to vote. And just text in the text chat. Vote for one, please. Eventually, you're right, we may have both. But right now, do you think we're going to have, are we in a deflationary mode or are we in an inflationary mode? Because this is going to have a big impact on how you position your investments and your trading accounts. Well, it looks like this audience so far who voted are pretty evenly balanced between inflation and deflation. And quite frankly, that's where the world's at today. Well, let's take a look at it. There are insane theories. I'll show you what it looks like, at least from our perspective. There are insane theories, ludicrous claims, preposterous notions, and that's just the politics of this debate. And it is a raging debate that both central banks, politicians, investors, and traders are having. And so let's get into this. I am not a Keynesian. I happen to be a follower of the Austrian School of Economics. Do we have any followers of the Austrian School of Economics in our audience today? Because the Austrian School of Economics, and if you want information on it, you can go to www.mises.org. Yes, that's correct. Mises and Hayek were the famous advocates of the Austrian School of Economics that preceded John Maynard Keynes and Keynesian economics. The Austrian School of Economics is the school of economics I've chosen to follow, going back to the very early 70s when I read Hayek's book, The Road to Serfdom. And I also had the opportunity to meet Harry Brown through a book he wrote called How to Profit from the Coming Devaluation, that's now become a classic. And it really changed and influenced my life, and it's really big. It had a big impact on my professional investment career. So let's take a look at the Austrian School of Economics perspective of a very simple but important question: what is money? Now, let's assume that all of you have money in a bank, and let's assume your money is stored in a bank, and this is your bank manager here who's sitting on top of your hoard of money at your bank. How many of you believe that your money is in the bank being protected by your president of your bank? Well, there is no money in the bank. The banking system has very little cash. In America, under the Federal Reserve System, it's known as vault cash, but there's very little cash available in the banking system today. And the reason is that most people believe money is M1, M2, and gold, and that we believe that's a very misleading measurement of the money supply. And in order to define, and we're going to define inflation and deflation in a moment, we've got to pay attention as to what is happening to the money supply. So the Austrian School of Economics defines money as cash plus credit. Cash plus credit. In other words, in America today alone, there's about $2 trillion of cash that freely circulates, but it's backed by $50 trillion of credit. So what's the most important component of the money supply? Is it cash or is it credit? Well, obviously, because of the size, it's credit. Now, the credit market, there are two components of a credit market: a willing lender and a willing borrower. But what happens to the economy of a country if a willing lender changes their appetite to lend? Because the perceived risk has changed. And that's what's happening in America today. There's plenty of money in America, but the money's not getting out on the street. The money's not getting lent, especially to small businesses, which are the primary engine for creation of new jobs. And then what happens in a system where the willing borrower changes their appetite to borrow and spend for conspicuous lifestyle? Well, obviously, we're in that condition today, and much of the developed world is in that same condition. Lenders are changing their appetite to lend. Borrowers are changing their appetite to borrow and consume. And what happens is a massive slowing of the economy. Now, I've gone to Webster's Dictionary to define our terms, and I think in order to have a legitimate debate on the inflation-deflation scenario and how it's going to impact the purchasing power parity of your currency going forward, regardless of what country you live in, we've got to define inflation and deflation. So let's take a look at what Webster's had to say. According to Webster's, inflation is an increase in the volume of money and credit relative to available goods. Now think about that for a moment. Most people, if I were to ask you previous to giving you the definition of what is inflation, you would have told me inflation is a higher price. Well, a higher price to inflation is like saying wet streets cause rain. Wet streets are the end result of rain, as higher prices are the end result of the inflation process. You see, inflation is not an event. It is a process. It's a process where we have an increase in the volume of money and credit relative to available goods. And to understand the inflation-deflation debate, we must understand money and credit is based on supply and demand. Supply and demand for both. Now, what's happening in the world is that, especially the developed world right now, and this is in the United States, I got this data from the Federal Reserve Board, is that bank credit plus commercial paper is shrinking or falling at a precipitous rate. And I'm looking at this chart from 1970 through 2010, and it continues to plummet. The gray bars in the background are periods where we had recessions, but you can see very vividly during periods of recession, the bank credit plus commercial paper year-over-year change is falling at a precipitous level. Now, we can debate, again, the chicken or egg discussion, which came first, but it is what it is. And this is having a paralyzing, slowing, and in some sectors, negative economic growth profile in the world. Now, let's take a look at deflation. Well, according to Webster's, deflation is simply the obverse of inflation. That is, it is a contraction in the volume of money and credit relative to available goods. And I'm here to say what almost everyone misses is the credit component. And again, ladies and gentlemen, if a willing lender changes their appetite to lend because of the perceived risk of lending, and the willing borrower changes their appetite to borrow and consume, what's going to happen to the economy? Well, it's going to slow precipitously. And this is exactly what causes the symptom of deflation, which is a falling price. Because we have this huge capacity to produce goods and services, and in fact, what we end up with is a slowing of the velocity of money through the economy. Now, the velocity of money through an economy is pretty simple. It's basically how many transactions or turnover of the capital do we give in a given period of time. If people get in a state of fear and slow down their conspicuous consumption pattern, the money, the velocity of the money of the economy precipitously falls. And take a look at this. Again, I got this chart from the Federal Reserve Board. This is from 1959 through 2010. The gray bars in the background, again, are periods of where we had recessions. And you can see, ladies and gentlemen, that the velocity of money started to slow way back in 1997 is where we started to see evidence of the slowing of the velocity of the money. Now, since 1900, the velocity of money has been on average 1.67. And I believe we are well on our way back to that average. Remember, markets are mean reversion animals. That's what markets do. Mean, the average, reversion to the mean. And I think we're going back down to where we were before as far as velocity is concerned on this time. Now, what this has done for us is our corporations borrowing and spending, our corporations expanding their infrastructure to produce more goods and services. This is normally known as CapEx, or capital expenditures. Well, take a look at this chart. What we're seeing is that industrial production in deep red is growing, although we've had some shrinkage in industrial production and output here on the hard right edge. But let's take a look at U.S. capacity utilization. Note that we are producing more output by using less of our capacity. In other words, we've seen capacity utilization drop from the 80% level all the way down below 70%, and today we're back up to 75%. So you don't have a need. And what's happened is the average American corporation has become more productive. They're getting more output per worker. And this is one of the reasons, and we've seen no need to create new jobs and no need to create more infrastructure to produce more goods and services. So I don't see any reason why prices should be rising. As a matter of fact, in America today, on average, if you look at the whole economy, the prices of goods and services by and large are falling, and there isn't a lot of pricing power or pricing pressure. Now, we saw this condition in Japan, and I think in America and the rest of the developed world, we can learn a lot from the Japanese experience and what their government did to try to get the economy started. First of all, I admire the fact that you all are trading currencies because the flight to cash and cash equivalent I believe is a tremendous skill to have, because I believe cash and cash equivalent is going to be the asset class that is going to have the most buying power as deflation starts to play out across the globe. So I want to compliment all of you in this at FX Street for being sensitive to having a good exposure and skill to trade cash and cash equivalent versus other assets. Now let's take a look at what happened to cash and cash equivalent during the deflation in Japan that really started in 1989. Take a look at this. In 1989, it was an incredible year. It was the year that the Japanese deflation started. It was the year that the Berlin Wall fell, and it was the year of Tiananmen Square in China. So 1989, I think, when history is written, is going to be a very, very important period of time. And let's take a look at what's transpired in the deflation, the credit purge, the 2 decades of credit purge that's taken place in Japan. In December of 1989, it took 38,900 yen to buy 1 unit of the Nikkei index. And notice we had this 20-year secular bear market that economists are now calling 2 lost decades. And today we have the Japanese stock market trading at about 10,000 yen. So in other words, we've had an 80% decline in the Japanese stock market measured in yen. Another way to look at that is the yen appreciated 80% in purchasing power parity relative to the Nikkei index. The yen also appreciated dramatically relative to real estate in Japan, both commercial real estate and residential. In the last 20 years, the average Japanese home has fallen 65% in price and stayed down. Now, another way to look at that is the Japanese yen has increased in purchasing power parity relative to the inflated asset prices of real estate and equities that took decades to produce and only 2 decades to completely be extinguished. Now, what did the Japanese government do to try to turn this around? Well, the Japanese government and leadership tried a classic Keynesian approach. Now, here at Online Trading Academy, we're not Keynesians. Remember, we are followers of the Austrian School of Economics. And let's learn something from this experience, because I believe your countries, where you live, especially some of the European countries out there, and of course America, can learn from this experiment that Japan attempted to pull their economy out of a malaise. The principles of Keynesian economics subscribes that if the public won't borrow and consume, then what we need to do is create an environment of cheap liberal credit, have the government do the borrowing and deficit spending to replace the consumer and corporations who, because of fear, have turned to a more conservative appetite for borrowing and spending. And what ends up, it looks like this. The private sector in Japan's debt as a percent of GDP peaked at 273% of GDP, and today has fallen in the blue line at a substantial rate of decline to 113% of GDP. What did the government do? And tell me if this sounds familiar to you. The Japanese government brings their Fed interest rates down to 0. They borrow money like a drunken sailor, start to prop up the zombie banks and corporations, create a whole bunch of government jobs, and they triple debt as a percent of GDP. And debt as a percent of GDP goes from 52% of GDP, and today, this is a little dated, it's not 170% of GDP, it's right at 200% of GDP. So the Japanese government almost quadrupled debt, federal debt, as a percent of GDP. Now, here's my question to you. Did it work? Well, first of all, does this scenario sound familiar? Well, it sounds familiar to me because, ladies and gentlemen, that's exactly what Europe's doing, and that's exactly what America's doing, and it's a classic Keynesian prescription. And somebody tell me, if it didn't work for Japan, why is it going to work for America? why is it really going to work for Europe? Is the real solution, if debt got you in all this trouble to start with, is the real solution to borrow more and kick the can down the road to the next generation? Let them worry about paying it off? Well, I don't think that's based on sound economics, and I don't think it's going to work. Now, let me show you why I believe Europe's in trouble. Now, many of you live in Europe, and you're much closer to this challenge than I am. But this is my back of the envelope understanding of what the real challenge is. Here we are with Greece, small country, what, less than 1% of the GDP of America, less than 5% of the GDP of California. How can such a small country create such uncertainty in the world? Well, let's take a look at what's happened. The problem is that the credit purge era is very contagious. Take a look at this. Greece owes money to Ireland. Ireland owes money to Spain. Spain owes money to Greece. Greece owes money to Portugal. Portugal owes money to Ireland, who also owes money to Spain, who also owes money to Ireland. And Ireland owes money to Italy, who also owes money to Greece, and Greece owes money to Italy. You see what I'm saying? We've got this incredible incestuous relationship. And where is all that risk concentrated? Well, it's concentrated right here in the center. Billions and billions and hundreds of billions of euros of risk concentrated in the banking system. And what this creates is tremendous uncertainty. From my perspective, this looks like the family tree of a family reunion in Arkansas. Incredibly incestuous relationship. And of course, some of that risk is exposed at U.S. banks as well. So where does America fit in all this mess? I'm going to tie this to gold in just a moment for you. Well, here in the UK, this is European government deficit spending as a percent of GDP. We've got the UK out here at about 13%. Spain's out here at about 11.5%. The U.S. is at about 11.5%. And we've got Greece here at about 9.5%. And France is down here at a little over 8%. So, ladies and gentlemen, the U.S. is not much better off than Greece. From that perspective, as a matter of fact, if the U.S. applied for membership into the European monetary system, I doubt if we would even qualify. Now, there was a great economist in the late 1800s by the name of John Mills from London, and he asked a very important question. And the question is, do panics and crashes destroy capital? And he made a very astute observation that at first is difficult to get your arms around, but once you understand the principle of what he's discussing here, it becomes rather clear that financial panics and crashes do not destroy capital. Well, tell that to Enron and Lehman Brothers and Bear Stearns and AIG. He said they merely reveal the extent to which it has been previously destroyed by its betrayal and hopelessly unproductive works. And examples of that are Greece and Lehman Brothers and General Motors and Chrysler and AIG and Fannie and Freddie and Bear Stearns and et cetera, et cetera, et cetera. You see, ladies and gentlemen, the balance sheet of General Motors, of AIG, of Chrysler, Lehman Brothers, and Bear Stearns were quite frankly disintegrating internally in a stealth form before the panic and crash finally precipitated and finished off the work. Think about that for a moment. Now, for those of you that agree with me that the world economic uncertainty is going to continue, I want to bring to your Treasury Secretary Timothy Geithner, who said our nation faces the most severe financial crisis since the Great Depression. By the way, I would call that the mother of all credit purges as a percent of GDP. He said it's a crisis of confidence, of capital, of credit, and of consumer and business demand. And I think he's spot on. I think this is the most crisp articulation of the challenge we face. And rarely do we get candid conversation from our politicians and bureaucrats in Washington. But what do you think he meant? It's a crisis of confidence. Well, here's what I think he meant. I think he was talking about the risk of eroding world saver confidence and their ability or appetite to recycle their savings to America. Let me tell you a very little known fact. America borrows 80% of the world's savings. Or another way to look at that is 80% of the world's savers trust America enough to recycle their savings to America. And ladies and gentlemen, capitalism needs capital. Capitalism needs capital. Now, what about unemployment? Are we going to be creating any jobs in America? Well, not anytime soon. Now, employment, this is the S&P Composite Index, and unemployment is usually a lagging indicator that moves inversely to equity prices. Take a look at this. And I think we're going to continue to be very, very stressed for the creation of jobs because there are just no incentives for small businesses in America to create jobs. Historically, what's got us out of recessions, and we've had many recessions in America going back to the 1940s after World War II that we got ourselves out of. And I'm showing you in this chart that this looks to me like the new normal for jobs. Now, I'm showing you from 1948 through 2007 various recessions we've had and how jobs, percentage job losses took place, and then there was a recovery period. But this is where we are today. So on a relative basis, I want you to note that what we're going through today is much worse than anything we've seen since the Great Credit Purge of the 1930s. And I want you to keep that in perspective as you're trading foreign currencies. Now, what's the U.S. going to do about this? Well, it looks rather inflationary, but I want to share with you it's not going to be that inflationary because the credit purge is happening at a faster rate than the governments can borrow and spend. This is our history of federal debt as a percent of GDP. And notice before World War II, our debt as a percent of GDP was down in the area of about 40% of GDP right down in here. During the war, our debt as a percent of GDP in America went over 120% of GDP. And then after the war, we Americans paid down our federal debt. And the way we did that was by raising taxes. And note that federal tax brackets were in the 90 percentile in America. But we got our debt paid down, and this is what it looks like today. What it looks like today is, this is by the Office of Management and Budget's forecast through the year 2015, that here we are today right in this vicinity of almost $12 trillion of debt growing to over $19 trillion of debt. And on the surface, that looks rather inflationary. But here's the problem. The problem is that debt, total debt as a percent of GDP, is over 369% of GDP. So the previous chart is just federal debt at 19 trillion, growing to 19 trillion at about 12 from about 12 trillion today. But the total debt picture, that's public and private sector debt as a percent of GDP, is just over the top. And here's what my concern is. We've got about $50 trillion of debt that we talked about earlier that's already in place. And what's happening in our fractional reserve banking system is that the bid on these credit instruments are shrinking at an alarming rate. Quite frankly, the asset values and the credit instruments are shrinking at a faster rate than the government can borrow and spend and deficit spend. The net effect is the cash that's left over has more buying power, and that's why I believe we are in deflation. Now, what evidence do I have that we're in deflation is that there's a high probability double-dip recession coming. Well, one of my favorite indicators that I've used for 40 years is the price of copper. We've seen copper. This is our 50-period moving average in blue, crossing over our 200-period moving average in red. Copper today is below the 200-period moving average, and I think it's headed lower. And we've seen a rather aggressive decline in the price of copper. And what copper is telling us is that, and if we break this support right here at 3 on copper, I think we've got I think copper is telling us that we have a high probability double dip recession in the last half of this year. Let's talk about gold. As John Kennedy was talking about, there's a tremendous myth around gold. there's a lot of misinformation that's put forward by politicians. Keynesians, of course, don't believe in the gold standard. They believe that a fiat currency backed with a political promise is a better system. The Austrian School of Economics has a totally different perspective on this and believe that we should have a gold-backed currency because gold has been real money for over 3,000 years. By the way, I don't have a clock handy. Can someone tell me what time it is or how much time I have left? Let's take a look at this. Just type it into text if you don't mind. Let's take a look at this. Gold bullion prices. This is gold bullion right here in black. And notice that gold bullion prices are outperforming gold stocks. Now, historically, gold stocks for decades have traded at a premium to gold bullion because as the gold bullion price would go up, the operating margins for mines would improve. Take a look at this. Now we're seeing gold. You see this gap between gold stocks and gold bullion again being in black? I call this the canary in the coal mine premium. And what I mean by that is that for years, decades, centuries, gold has been the world's canary in the coal mine. In times of economic uncertainty, in times, gold has played the role of a flight to safety. It's a safe port in a storm. And, you know, we've been told that gold does not perform well in depressions. Well, gold performed exceedingly well in the Great Depression of the 1930s and when we were on a gold standard because gold was money in the 1930s. The U.S. dollar was convertible into gold at a fixed rate of exchange of about $26 per ounce. It came out of the Depression at over $42 an ounce. That's a substantial improvement in the purchasing power of gold in the worst credit purge the world has ever seen. So gold is also performing quite well now. As a matter of fact, I want you to take a look at this chart. I'm comparing. Historically, we've seen gold, silver, and platinum, the whole precious metals complex, trade in relative pari passu percentage changes. Now we've seen some divergence. We see gold prices here, again, accelerating in rate of change against platinum and silver are on the bottom here. Now, why is this? Again, this is my evidence of canary in the coal mine effect of gold, telling us that there's more economic uncertainty ahead, and it's already priced into gold. There are people fleeing euros, there are people fleeing pound sterling, there are people fleeing currencies all over the world, and it's moving into gold at a much faster pace than silver or platinum. Most of the demand for silver and platinum, it's estimated 80% of the demand for platinum and silver is industrial, maybe 20% monetary influence, but gold is just the opposite. Over 60% of the demand for gold is monetary, 40% industrial. And when you look at gold in jewelry, many of the people that buy gold bullion jewelry, especially in the Middle East and in Asia, that is their form of money or savings. So don't look at gold jewelry fabrication as necessarily an industrial application. In many parts of the world, we're seeing that gold jewelry in jewelry form is money for that culture or has a monetary application. Now, where does that leave us with silver? Let's take a look at silver. We have a rising wedge, a bearish rising wedge right here on the hard right edge. We've 3 times tried to break through this silver price right in here, and it's having a very, very difficult time. As a matter of fact, I'm looking for silver to precipitously decline relative to gold going forward because of its industrial nature versus its monetary demand. Now, how has gold performed versus various other fiat currencies? And virtually the whole world today, ladies and gentlemen, is on a fiat currency system. Here is how gold has been priced in dollars. Here's how gold has been performed priced in euros. And here is how gold has performed priced in yen. As a matter of fact, one of the very best um, performances has been the yen gold pair. And I think that's how you need to take a look at it. So let's take a look at gold today. Where are we on gold today? Well, from the Online Trading Academy perspective, and by the way, if I have other research I've done on this and other webinars, if you'd like to email me at the end of this, john@tradingacademy.com, I'll send you my work on this topic. Plus FX Street, if you go to my bio, John O'Donnell bio on FX Street, they have Maud and her team have archived multiple webinars I've done for FX Street over the years. You can see how they've evolved over time. So let's take a look at this. Here's where we are in gold today, and I think this is a classic. Gold has created this in pink rising wedge. It's at and we have found tremendous resistance right here at the 1250 level. We broke through late last week. It was not able to hold its position. As of yesterday, we had a very substantial sell-off. And this 1250 level, I want you to mark this down, it's a very, very important resistance level. And because it's a Fibonacci retracement level of 1618 right here. If, as we've seen so many times in technical analysis, what was once price resistance, if we can get through it and find support, it will become price support. And if that's the case, the next movement for gold is to the 1850 level, which is another Fibonacci level up here at 0.2. So ladies and gentlemen, I think we're going to bump against this 1250. I think we've bumped up against it 4 consecutive times. It's had a very difficult time getting through it. It got through it at the end of last week, but it's not been able to hold it. And I think the real key is if this European financial, monetary sovereign debt crisis continues to play out, we're going to see if this 1250 level is either going to remain resistance or if it's going to become support. And then in that case, we could be well on our way to the next level of support. Now, how many of you believe that gold is overpriced at $1,200 an ounce? Give me a yes or a no. How many of you believe that gold is overpriced at $1,200 an ounce? Yes or no? Well, a lot of you are saying yes. Why do you believe gold is overpriced at $1,200 an ounce? Take a look at this, ladies and gentlemen. What you're comparing gold to in priced at $1,200 an ounce is a fiat currency. Is a gallon of gasoline overpriced at $3 a gallon? Well, let's take a look at this. In 1980, gold was priced at $8.50 an ounce. Now, today we've got gold priced here at over $1,200 an ounce in black. But ladies and gentlemen, if I were to convert the purchasing power parity of $850 in 1980 to today, gold should be priced at $2,359 an ounce. So to have gold priced today at $1,250 an ounce is not high at all in relative purchasing power parity. See, most of you do not look at the purchasing power parity of your euros, your pound sterling, or your dollars on a constant basis. I mean, think about this for a moment. You're only looking at its purchasing power parity on a fiat inflation basis. Well, that's unrealistic. I mean, think about this. What if a meter wasn't well defined? What if a BTU of energy wasn't well defined? What if an hour wasn't 60 minutes everywhere in the world? If you're going to price something, you must use a constant metric of measurement. And ladies and gentlemen, to see gold at even $2,000 an ounce on a relative purchasing power parity basis would not be unrealistic at all. Why is this? Because of the massive loss of purchasing power parity of the U.S. dollar. For the last 76 years, since the bottom of the Great Depression, where dollars appreciated dramatically in purchasing power, the prices of goods and services dramatically fell. The dollar is down from 1933 through 2009, 94%. So why is there a flight to the dollar today? Well, the dollar is the best home in a bad neighborhood. The rest of the fiat currencies of the world are in worse shape than the U.S. dollar. And that's exactly what we're seeing. By the way, I have the opportunity to channel with George Washington, and after I showed him this previous chart, George Washington told me that we should redesign the face of the $1 bill. Now, one of the things that I like to do, and that's what this chart is measuring now, and I call this the Dow Invisible Purchasing Power Parity Crash. Take a look at this. In other words, what I do, and you can do this yourself, every Friday, and you don't have to use the Dow, you could use the FTSE, or you could use the DAX. How many ounces of gold does it take to buy 1 unit of the DAX? How many ounces of gold does it take to buy 1 unit of the FTSE? How many units of gold does it take to buy 1 unit of the Dow? In other words, how many units of gold does it buy the average home in your country or your community? In other words, use gold as your denominator. And you could use oil, you could use the CRB index, you could use anything, but an online trading academy, we like gold because, again, it's been real money that no central bank can print. That's why we like it. That's why central banks hoard it. Take a look at this. This is the 80-year Dow Gold ratio, and what is it telling us? Well, coming out of 1932, where the Dow Gold ratio was 1-to-1, in other words, it took 1 ounce of gold to buy 1 unit of the Dow. This was a real bull market in stocks going all the way up to 1967. Then we had a bear market in stocks relative to gold all the way to 1980, and the Dow Gold ratio goes from 27 ounces of gold to buy 1 unit of the Dow down again to 1 ounce of gold. Right here in 1980 it was $8.50 gold, $8.50 on the Dow. This was the bull market coming on with Ronald Reagan's election. And what did Reagan bring to the party? Well, coming off Jimmy Carter, he brought great confidence. Confidence for lenders to lend, confidence for borrowers to borrow. Velocity of money accelerates through our economy. Earnings of publicly traded companies soar. What ended up was we had a 20-year bear market in gold and a 20-year bull market in equities. And it goes all the way up to here from 1-to-1 ratio in 1980 to a 44-to-1 ratio right here. And since first quarter of 2000, ladies and gentlemen, we have been in a bear market for the Dow measured in units of gold. Of course, we've seen gold. This was at the peak here, it was 11,700 on the Dow divided by 250 gold. And where are we today? Well, today we're at about 10,400 on the Dow divided by $1,200 gold. That's about a 9-to-1 ratio. So that chart today is right here where my cursor's at. The red line that you see here is the 80-year average Dow Gold ratio, and that's about 12-to-1. This is what it looks like today. Now, you can get this chart at investmenttools.com. I thought you might enjoy this picture. Let's kind of end on this. This is a bar of gold. And in other words, this is like 500 pounds. It'd be 250 kilos of gold. That's about 500 pounds. World gold production continues to grow, and it continues to grow because the price of gold in nominal terms continues to grow. I said earlier, there's a lot of ways to trade gold. You can trade gold coin, you can trade gold bullion. The New York Stock Exchange has a new futures contract. That's where I trade my gold. And it allows you to take delivery of mini gold and silver physical contract. The Japanese, by the way, in Macau, probably like this. Keynes had to say the only real true application for gold is that it be used to line urinals. I used to say, well, if gold lined urinals, we wouldn't have any urinals left. Somebody would steal them. Take a look at this. This is the largest gold nugget ever been found in California. Weighed 156 ounces. By the way, does that look like a head and shoulders pattern to you? I think it's very little to say about gold. But on June 9th, there was this report on Bloomberg. Bernanke said that gold prices, which surged to records yesterday, are sending a different signal on inflation than raw materials. He said other commodity prices have fallen recently quite severely, including oil prices, food prices. The CRB index is down precipitously. And he said, so gold is out there doing something different from the rest of the commodity group. And yes, It's acting like the canary in the coal mine. The base metals, lead, copper, and zinc, are very weak. The whole CRB index group is weak. None of those are telling us that inflation is ahead. Gold is telling us that there's more economic uncertainty ahead. Okay. I need to wrap this up. We've only got about 3 minutes left. We see, ladies and gentlemen, the total demand for gold is still growing. The average price of gold is accelerating. And the total world jewelry demand is still very strong relative to where it was in the 1980s. But we've seen some weakness with price here recently. Total mine production is leveling off. Notice the number of ounces coming out of our gold mines are leveling because it's more and more difficult to find gold. But yet demand for gold continues, and this gap between demand and supply. So where's the rest of the gold coming from? Well, it's coming from gold scrap, and it's coming from the hoards of gold in central banks. Central banks, on occasion, primarily through IMF leadership, will release gold. Do I think silver is going to gain in value? No, I think we're going to have a recession. If you notice, silver is lagging, and I think silver, because its primary has big industrial demand, is going to lag gold. Gold is what people turn to in times of economic uncertainty, and to a lesser degree silver as well. Don't forget this chart. Gold priced in constant dollars, if we want to go back to the 1980 peak, should be trading today at over $2,300 an ounce. Gold is not overpriced at $1,200 an ounce. What do I think about platinum? I think platinum's primary demand is industrial. Its price appreciation is lagging that of gold. What happens when we run out of gold? Well, the only place to get it will be from the central banks. And if we run out of gold someday, you're going to see gold at $5,000 to $10,000 an ounce. So, ladies and gentlemen, I've enjoyed being with you today. I want to add one more thing I want you to follow, and that's to go to powertradingradio.com. This is a new radio show that we produce by Merlin Rothfeld and myself. You can email me, john@tradingacademy.com. Also, if you want to learn how to trade gold and silver on the New York Stock Exchange, new contract, it has great opportunity. And just contact metals at NYX.com. They will send you a free PDF form to show you how to trade gold on the New York Stock Exchange Life, or you can contact Jennifer Ropiak. I've enjoyed being with you today. My name is John O'Donnell, and please email me, john@tradingacademy.com, or go to fxstreet.com. They have recorded this presentation, and send a copy of it to your friends. God bless you all. Good luck.